For years, pension funds have been confined to government debt, listed securities, and limited real estate or private equity, all in the name of safeguarding returns for savers. But with Uganda's ambition to grow its economy tenfold in the next 15 years, from 50 billion to 500 billion US dollars, fund managers must look ahead to asset classes that promise stable, long-term returns. One asset class often overlooked is real estate, which has already proven to be a game changer for pension funds across the region and in Southern Africa.
The government of Uganda has created a very ambitious program to grow the Ugandan economy from $60 billion today to $600 billion in 15 years' time. What that will mean is that the government of Uganda is likely to be richer in 10 years' time, and the need to borrow at 17% is going to reduce. So a scheme that is looking forward, that has strategic foresight, must prepare itself to change, because a 25-year bond today that is at 17 is likely to be at 12% 10 years from today. So how do you replace a high-earning investment with something else?
The bet on real estate is clearer when viewed against Uganda's demographics. With one of the youngest populations in the world, demand for housing is set to surge. The country already faces a 2.5 million housing deficit, an opportunity pension funds could seize.
If you understand real estate, but also understand your captive market, you can generate returns of up to 20% if you understand who you are doing this real estate for. In South Africa, for example, real estate for retired persons is a very high earning segment. In Kenya, we have been told student housing, providing hostels of a very high quality, very similar to hotels, has been providing up to 25% returns, attracting American investors in Nairobi.
So it's important that the long-term savings that are being mobilized and are growing try to find other alternative assets that develop the general economy. So infrastructure presents an area that is stable, is predictable, and can be managed in a way that safeguards, first and foremost, pension assets, but also builds the underlying base for economic development.
Still, the regulator urges caution, pointing to past controversies where NSSF was entangled in protracted legal battles over land transactions.
We need to have a clear framework that can support this conversation. How are the capacities developed to make decisions? Are the trustees competent? How is the documentation clear to look into these disclosures and to provide that positive returns and attractive yields to the members?
Returns on government instruments are projected to dip in the near future. This makes diversification urgent. Real estate offers potential, but it demands patient capital, the kind only institutions with strong balance sheets like the pension funds can provide. Rachel Nabisubi for NTV Business.